Perfect. That sounds good. Well, if you're going to hand it to me, Hamish, then I've only one thing to say, and that's a very good morning to everybody. Kia ora, and welcome so much to yet another Survive to Thrive. It's the webinar by New Zealand's exporters for New Zealand's exporters. As together we carve a path towards some renewed prosperity for ourselves and our businesses, our family, and of course for our country too. We've got an amazing panel lined up from both Australia and New Zealand today to tackle the question that's been on all of our lips. If you're just joining us right now, please jump into the chat and just say hello to everybody. It's great to know that you're here in person. Every single one of you out there really matter, because this is about the export community working together to help each other so that we can all get through this in one piece. Now, if you've been paying attention to what's been going on this week, you'd probably be aware of what our topic is already. We've been over 10 weeks of this, believe it or not. Hamish and I, we haven't moved from the same position for 10 weeks. Feels like that. But over 10 weeks, we've been around the world. We've dipped into technical subjects. We've looked at markets. We've looked at industry verticals. And so we're going to continue to do this for quite a number of weeks still. So it's great to have you here. Today, we've done a little bit of a pivot in terms of our topic because we've been made aware of an emerging issue that it's actually very important that every exporter or potential exporter is made aware of, and that's the changes that COVID's made to the challenges of getting paid and managing risk. And as we know, then getting paid from anything from exports is already fraught with issues. And at the present moment, what we hope to do is to shed a little bit of light about what's going on and what you as exporters can do for yourselves and for your businesses as well. So Hamish, why don't we launch that poll and find out how everybody's feeling out there in the audience? When you're not on mute. You've done this before, Hamish. You know where the mute button is.
I know. I just had it covered by the poll.
You've decided covered.
So this poll that we're doing here, which will be relevant for some of you, two-part question. So if you're exporting, put yes, but I know there'll be some people on here that aren't. But really what we're interested in here is, since the COVID crisis, has your ability to get paid from your export markets been better, the same, or worse? So might not be too many surprises there. And also the second part there is, if you're exporting, including maybe just online, then just say yes, or if you might be a no, or getting ready to export. So we've got that poll. And also, folks, just as we go through today, if you have questions, we will be getting to those nearer the end of the call. You'll notice there is also a Q&A section down the bottom. So if you put your questions in there for the panelists, or just general questions for anyone, put them there so we can organize those better, because sometimes in the chat they can get lost in there. So Q&A for their questions, and we'll make sure we get to those. And then also, probably just while waiting on this poll to get completed, just that this core session goes through to the top of the hour, 11 o'clock, and then we will, if you do want to stick around, if you've got some more specific questions for your situation, we'll have the after party, as it were, and so you're welcome to stick around for that, for some other Q&A where we'll bring you on, where we can see you and you can talk, etc. Okay, so I think we'll given it's been a minute and a half on the poll, we've only had half the people vote. But we'll go from there. That's what we'll call that statistically relevant. So let's end the poll, and I'll share the results. So what we can see here is that it's not better for anyone. Probably no surprise there. And a good third of people are finding it worse. Right. So and also then just a sense of those that did obviously answer. There's two-thirds of them are actually exporting. So that might help provide some context for what we're going to cover off now.
Yeah, absolutely. And it's great to see that we've got a nice balance of people who are actively out there in the markets, and also some people who are just getting ready, because we've got plenty of things that everybody can take away from the session today. Which reminds me to turn to our panelists and to say good morning to you all. And as is now the accustomed fashion, after 10 of these, I'm going to ask the panelists to introduce themselves. So first of all, I'm delighted to welcome back Nadine Hill from NZT. Nadine, you've made it for a second time.
I know. Oh, great to be here, Andy. Hi, everyone. I'm Nadine Hill. I'm an investment manager at NZTE. NZTE is the government's arm that supports companies exporting into offshore markets. So we have a trade arm that supports them on the trade front, and an investment arm that supports them raising capital to fund the growth.
Oh, that's fantastic. It's lovely to have you here this morning, Nadine. Welcome back.
Thank you.
And I'm going to turn to Chris Chapman. Chris, good morning. How are you?
Kia ora. I'm really good, thanks, Andy. I'm with New Zealand Export Credit. We're another government agency that helps with the trade credit insurance for exporters, or underwriting the finance that a bank might give an exporter where your bank or your insurers is unable to.
And and this is the second appearance of the office on this as well. It's like, so Chris is making his first appearance here, but it's going to be a goodie, I can tell. Not that it's a competition, but it's a competition. Marie, good morning. I'm going to pick on you. How are you?
Good. I'm great, thank you. Good morning, everybody. I'm Marie Erskine, working at BNZ, International Trade Finance Specialist. We have a whole team of specialists covering the country, working with BNZ, out there talking with exporters, importers, looking at how we can mitigate risk, and looking at risk solutions fit for purpose for those particular businesses that we're talking to.
Oh, thanks so much for joining us, Marie. It's lovely to have you on the panel. And
Thank you.
just going to jump across the ditch. And Matthew looks like he's sitting in the big Sydney. Where are you in the world this morning, Matthew?
G'day, Andy. How you going, mate? In the centre of Sydney. Obviously just doing what we do down here around COVID. We're sort of back into the office at the moment, so life's good. My function,
where are you from?
Sorry, mate?
Where are you from and what do you do?
What do? I'm from World First. We are an international payments company. In essence, what we do is we make international payments at a local market simpler, easier, and faster.
There we go.
It's just collections of money.
Beautiful. Great. Well, I look forward to connecting. And thanks so much for getting up early to join us here in New Zealand today. And last but not least, someone's got to be last. Mike, good morning.
Someone always has to be last. Good morning, everybody. My name is Mike Kays. I look after the credit insurance risks for predominantly clients of Willis Towers Watson insurance brokers. And I've been in the space for 21 years now, and I've seen a lot of changes in domestic and export markets. And clearly, this is a really great export market discussion today. And I'm really looking forward to participating, Andy, and I'm really looking forward to hearing the questions from attendees today as well.
That's great. Yes, thanks for joining us, Mike. And you made a really good point, because it's all about you out there in the audience. So as Hamish has said, there is a Q&A button at the bottom, and a chat as well. If you want to speak to anybody else in the audience or any of the panelists individually, then just hit a note into chat. If you've got a question that you'd like us to answer, then stick it into Q&As. We're simple people here, and we like to separate our questions from our chats. Or rather, Hamish and I are simple. That's probably more the points. So if you've got a question, stick it in Q&A. If you've got some chats, put it in chats. But let's get into the business of the day. What say you, Hamish? Go, all right. Nothing.
Yes.
You're on mute again.
Muting myself. Let's go.
The cat is on your keyboard. Let's start today and have a little bit of a roundup from NZTE, please. Nadine, if we can turn to you first, just to get a feeling for what the sentiment is of exporters that you've been talking to, given that we're now firmly established into level 2, and what's happening.
Sure. So it's quite mixed at the moment. Obviously, economies around the world have started to open up, and some obviously more than others. And that food, beverage, and FMC space, that's still been strong. That's getting even stronger. Meat outlook looks strong. Wood's bounced back. There's some really good signs around our core exports. Actually, exports for the last fortnight in May are at the same level as they were the year before, but that's in a real top line sense, and reflects our economy as a whole being strong, and those products that people need to survive. And house companies are continuing to do well. Some of the good signs, the machinery and equipment that are exporting to countries and into industries that are in food and industries that are bouncing back, they're doing okay. But in terms of other industries, anyone with exports at the high-end consumer goods, furniture, construction type goods, those companies are still really struggling. the thing is that governments around the world are still pumping a lot of money into the economy, so it's really difficult to gauge yet what the true longer sense demand is going to be at the moment. So there's a bit of cautious optimism at this stage, but that's overall. But it's still probably too early to tell, and it'll be in a few months' time where where you'll see some more pain probably eventuate.
So just to go back, we're always like a reason to be cheerful is fantastic on a Friday morning. Yeah. It's like the demands that you're seeing at the present moment that's underpinning those strong export numbers. What sectors in particular are they again?
So that's like health, that's like food and beverage, that's like wood, that meat, those core New Zealand products that we've always done well at, and there's always going to be a strong global demand for. It's more the other sides of the market that where the pain is still hurting and it's difficult. Consumers are still cautious overall. They're buying a few products, but in terms of those high-end consumer good products or furniture or discretionary products, those are still areas that are core, that are still relatively slow at this stage in terms of demand.
Right. Okay. Thank you. Thanks for the high level update, Nadine. That's much appreciated. What we're here today to talk about is the challenges of getting money out of markets. It's actually the trading part of trading, and it's part of the challenges of business as usual for any exporter. Just turn to you, if I may, Chris. Why is it so much harder to get money out of an export deal than it is from a domestic deal? What is it theoretically that actually makes this so tough sometimes?
Can be two things. One, first of all, is having comfort whether to offer credit to a buyer offshore. So, if it's a domestic buyer, often your access to understanding, are they good for that? What's the sector or their industry that they supply into? You've got a better understanding. So when it's offshore, often having that market intelligence of really understanding how good is that buyer to pay, and then if they don't pay, again, you've got the tyranny of distance, I guess, of not able to go around and knock on their door and have a chit-chat conversation. Now, there are options through debt collectors or whatever that you can leverage, but you've got that difficulty of not being in market.
Yeah, I think the tyranny of distance is the most eloquent way I've heard it put for a long time. So that tyranny of distance is actually just one of visibility and actually knowing who you're trading with and having that security around that. So from this, it's like, what's the negative impact that this has on exporters in terms of that unable to create that visibility and to create that surety?
Well, it is. It's if I'm hearing you right, it's that ability to understand what those risks are and their finances, I guess. Sorry, is that with the question?
Yeah, absolutely. Yeah. What's the downside of having that tyranny of distance?
Yeah. Look, the other thing, one downside is that ability to be able to, go and see and work out a solution. The other one too is the time. If you're offering credit terms, invariably the credit terms that a buyer wants overseas are longer than what your domestic companies want. So you've got to factor in the time it takes to ship or send the goods into that market, whereas in New Zealand you don't have that. So that cash flow cycle is often normally longer when offering credit to an overseas buyer, which again goes to risk, but also goes to how you finance your working capital.
So that's actually it's a really nice picture for anybody who's new into this space, because we're adding on the length of time it takes to send products from New Zealand to our export markets, and that has a huge impact on our ability to get paid and an impact on our cash flows. So this is where the whole trade credits and export credit world comes from. And what I'd like us to do before we talk about how this has shifted through COVID is actually, because there will be a number of people on the call today who are looking at this for the first time. It would be great just to try to understand what this ecosystem looks like, because it's incredibly supportive and interconnected, and maybe we can just walk through that step by step. So turning to you first, Mike, on this, if we possibly can, could you just in a really high level way just explain the concept of trade credit and how it helps you to support the cash flow problems that trading overseas creates?
Listen, absolutely. Thanks, Andy. I think, listen, everybody understands the concept of, insurance, and, you look to share risk with a trusted third party, and you do that for your motor vehicle and your house and contents, and then on your business you do the same thing for business risks. Credit insurance is no different, except when you're exporting, there's a whole lot of different risk factors that come into it. So it's not just the risk of non-payment of the products that you sell, because that's what credit insurance is all about. You have additional risks, as Chris touched on before, of political risks. So you've got the country risk that factors into pricing, and then you actually have the commodity and the payment terms that you're offering. So, so credit insurance is all about getting paid for your asset. Now, your asset is actually the invoice value of your goods. So that's what you're insuring. You would insure your goods whilst in transit using a marine policy or some sort of transit policy to get your goods there. But as soon as they're there and they're in the use or production with your client, the asset now is the money, it's the dollars, and that's what credit insurers are looking for. They're after they're looking to secure the payment terms. So that's what credit insurance is all about. It's quite simple, and I guess if simplistically, credit insurers actually don't mind too much about the product that you're selling. They obviously think about, from a salvage implication, if your product wasn't paid for, can they resell it somewhere else? Most of the time, New Zealand exported products will already have been sold, especially if it's fruit and veggies, or be commingled in some form of manufacturing process. So there's very seldom an opportunity to gain some recovery from the insurer. So it's all about the payment risk of your customer.
Right.
Does that give a pretty good overview, Andy?
If I can understand it, then anyone can understand it. What I'm picking up, what I'm picking up on this Friday morning is that what we're ensuring here is not being paid. So we're getting a third party to help manage the risk of the second half of our shipments. They might have paid a little bit in advance, but the second half being in default, and that's the essence of the need for insurance. So inside this world as well, I keep hearing LOCs and letters of credit being flung around, and also the fact that everything that you do around this space has a huge implication on your banking relationship. So, Marie, from your perspective, inside one of the big four banks in New Zealand, actually, what's an LOC and how does that fit into this picture?
Sure. Okay, just on that, just coming back to what Mike said, the majority of our customers would be working on open accounts when they're dealing with their overseas buyers. And so this is where the trade credit insurance is actually a very good fit for those customers. And it also works well with us being able to maybe extend longer terms and maybe bigger facilities to customers with the credit insurance that we have in the background. But when you're coming and talking about letters of credit are a form of a guarantee. It's a form of guarantee that is underwritten by the buyer's bank. So it takes the guarantee to the bank where the buyer is banking, and the risk sits with them. So the letter of credit is a flow of documents on the back of shipping of goods. And the letter of credit, you've got all your terms and conditions that have to be complied with to get payment. But it's definitely a conversation that we're having with customers at the moment. They're looking to mitigate risk, and letters of credit have been around for a long time, and we're sort of seeing that customers are coming to talk to us again about letters of credit. Predominantly, mainly the big guys have been using letters of credit because there are a lot of costs related, and is also a lot of administration behind a letter of credit. But it's definitely something you can look at when you're looking at buyers overseas.
So as a first-time exporter, how do I know that a letter of credit is not going to be enough, that I'm going to have to go and insure as well for that particular deal?
Typically, if you're using a letter of credit, you wouldn't insure as well, because a letter of credit is a guarantee of payment between the banks. It's governed by ICC rules, which is rules that are global. And so if you've got insurance and you've got a letter of credit, you typically wouldn't insure your customers if you're using a letter of credit.
Right.
Not always, but typically, yeah.
So is there ever a circumstance when you don't have a letter of credit, you don't have insurance, and you just self-insure and fly by the seat of your pants? Does that ever happen, or do you have to have one or two?
Well, yeah, you do. And we do have that conversation with customers because first time, but when you're dealing with your buyers and things overseas, you know, you really got to think that if you're going to load up a container worth of product and send it off overseas, like Chris said, you've got that distance, and you've got no money, and you've got no flow of documents, being the bill of lading title to goods, that you know, if your business was to lose that 100K and not get paid that 100K, you know, what is that going to do to your business? So you really need to be looking at your buyers overseas and doing your due diligence and working out, do you need insurance? Is a letter of credit the best option? So that's when you need to come and talk to us, and we can sort of go through the different options with you as well that are in there with the bank, but also with the team.
So what Hamish?
I just want to jump in here for a second. I'm just thinking in terms of the audience here. Is there, I mean, you talked about the big guys, but is there like a dollar value that a company, you know, that is too low to be looking at a letter of credit, or too low to be looking at insurance? Like, is it, if you're sending $20,000 worth of stock, is it not worth it given the admin around it, or what is there kind of a number?
No, I don't think so. I think with letter of credit, you can do any amount with letter of credit. It's just that there is administration that goes with it, and there is a cost that goes with it. But we have a whole team. We've got our whole team in the Key Park, our support team, and we're here to help with the documentation, the flow of the letters of credit, the setting up of the letters of credit. When those letters of credit come in from the overseas bank, we want to look at the country that's issued the letter of credit, the bank that's issued the letter of credit, the terms in the letter of credit. Can you ship within that time frame? Are these the goods that you thought that you were going to be sending within this, with what you've been chatting about with your overseas buyer? So when those letters of credit arrive from the overseas bank, we're having those conversations with our customers to ensure that we're helping them as much as we can to comply with all the terms and conditions, because that is their guarantee of payment at the end of the day. So our team are there to do that and help guys out and businesses out every step of the way.
Andy, can I just add to that question too? Like, we're underwriting a policy right now for a wine exporter for $20,000. So that's the credit limit that they're offering. And that's going to help them sell. They're forecasting $50,000 of sales to UK for the next year, but it gives them that confidence that they've got a bad debt covered. And around letters of credit, as Marie said, if you're a smaller exporter, it can be challenging understanding that documentation process. But look, there's a new business advisory fund scheme that's been introduced by the government just in the last few weeks.
Yeah.
It's administered through the regional business partners, and that money, you can get up to $5,000 to help you get sort of expertise support across a range of parts of doing business, and that includes financial cash flow management, which also may extend with, I know some of the people who are qualified providers on that, to help you with export documentation. So that's just something to know.
That's perfect. Hamish, would you mind sticking in a link to the RBP program in there, because it's a fantastic source of funds for that. Just to give us back to the high level from NZTE, Nadine, it's like we've got Treasury on this call, we've got banks on this call, we've got private insurers on this call, and we've got NZTE on this call. It's like, how does everybody fit together, and where do you go first? Do you turn to your bank first, or to NZTE customer manager first? How does it all link?
Yeah, and it can be a little bit hard to navigate the system, and it really depends on what you want. I think everyone on these calls is aligned with doing what's best for the customer. So certainly, when if it's an export problem, our customer managers will direct the company to the right person if it's not something that they can help with. You know, we work a lot on that. We work a lot with the banks. We work a lot with Export Credit Office, and a little bit with the insurers as well. So I think probably the person that knows your business, you know, I'd probably recommend going to the person that knows your business the best with, you know, and if that's not NZTE, that's your bank, you know. Hopefully each of those entities will bring in the other people. I mean, I'm certainly promote NZTE customer managers, but we're certainly not precocious about it, and we want so I guess I would recommend people go to the person who knows the business the most, that's been working alongside them on the export front, and often that will be an NZTE manager, and then they'll bring in other providers or direct you to other providers if that's appropriate.
And it's like going to the person who knows you the best, I guess, makes a lot of sense, because what we're talking about here is visibility and understanding of how much risk is enough risk. As Chris said, it's like the bar for being insured or running an LLC is actually quite small, but the risk is incredibly personal, and that's
Yeah.
why we need to connect with that person first.
Yeah, and if it's a cash flow problem, absolutely the bank. Do you know what I mean? Like if it's, you know, if it's you're wanting letters of credit and you're wanting a cash flow, I would suggest it would be your bank to go to in the first instance.
All right, that's solid advice. Thank you. Chris, I'm going to turn to you, please, and just let's look at the dark side here. I mean, COVID's had some seismic impact on the way that risk is measured and how that's flowed through. Could you just give everybody a bit of a top line of what's changed over the past couple of months and why that matters?
So trade credit insurers, there are 4 primary trade credit insurers who are operating here in New Zealand. They're globally owned. And what they've seen in the last, since COVID, is one, demand for their insurance increase. And in part, that is because maybe there have been companies who have self-insured in the past and now recognise with increased risks, it might make more sense to get insurance. Or secondly, businesses who may have previously been able to negotiate favourable payment terms, they've got buyers now saying, hey, look, we want to pay 30, 60 or 90 days later. And so getting trade credit insurance, one, it helps validate from a due diligence perspective, you know, if their business that they're selling to is still creditworthy. And then secondly, it protects them in case things go wrong. But combined with that is the private trade credit insurers, their overall capacity to take risk has decreased. So the role that we play is to try and fill that gap with creditworthy buyers. And so I'll give you an example of a company that we're helping right now. It does PPE, personal protective equipment. It had one real key buyer in the United States, and previously it was able to get paid up front. So they didn't need trade credit insurance. Demand for their products now increased, but some of the new buyers that are coming to them want payment terms. Some are state, a county fire authorities one, and so they have fixed terms, take it or leave it. And another's a big restaurant chain in the US where you think, okay, there could be some risk associated with that. And for new business, the private insurers have said, look, no, we don't have the appetite for that. So they come to us, and we do our due diligence, and we're looking to provide them with that trade credit insurance,
right,
to give them that comfort.
So Mike, from inside the insurance industry here, we're hearing from Chris that demand has gone up, but the expectation of risk and even the tolerance of risk has changed entirely. How's the insurance market and the reinsurance markets adapted to this? What's actually going on to try to get some balance again?
Really good question, Andy, because I think if we go back pre-COVID, risks were always assessed by the insurers based on financials, previous trading history of your customers, the markets that they are in, all those sort of good things that I talked about before. So fundamentally that's changed. We've all seen the landscape change. We've seen previously solid companies suffer financial setback, redundancies of staff, because their business has changed. Yeah. So the way that insurers are now assessing this risk has had to fundamentally change. They can't base it on last year's financials and management accounts and payment history in the market. So they've had to adapt. And so what that's created is a lot more communication between the insurance company. And as Chris touched on before, there are 4 major players in the New Zealand market, and we're well and truly looked after by them. They've done a fantastic job during this great period of uncertainty. So what they're doing is they are talking with your buyers behind the scenes to obtain more up-to-date information. It's a very fluid, changing dynamic. What we're saying to our clients is, if you've got a sale, before you actually put those goods on a ship or on a plane, make contact with your customer. And 3 questions you really need to ask them. 1 is, do they still need the product? 2, can they clear the product through the ports or through the airports? And number 3, can they actually afford to pay for them? And that's the most important thing. And that actually adds some comfort to the insurers as well, because if there is a claim instance, you've got some previous contact, perhaps an email, and it's always nice to have it in some form of writing, where the client says, yes, please sell me the goods, please ship them, and I'll pay for them. And if they choose not to, then at least it gives the insurer some better legal standing in getting that money back. So that's where it has fundamentally changed. The insurers have become not risk averse, but they've become very, very detail oriented. The chance of getting a Rolls-Royce credit limit now has gone. It's credit limits to reflect the risk that you are currently carrying.
This sounds like fundamentally incredibly unsettling. There'll be people out there who were a perfectly fine risk who now are unable to get any insurance. What's the outlook for companies like that, Mike?
Well, what we've seen is where those companies no longer stack up from a credit insurance perspective, we have seen an increase in larger deposits or payments in advance for the goods being shipped. And probably, as Marie touched on before, we've seen this move back to letters of credit because it's bank risk rather than actual client risk. And everyone loves a bit of bank risk, but it's more expensive, or can be more expensive. So there's just, again, it's a little bit of a balancing act. And also, you touched on before, if the loss to the business if they have a failure. If you're a business and you're running a 10% profit margin and you have a $100,000 bad debt, you have to turn around and sell $1 million more product to stand still. Yeah. And if you think that's easy to do, why are you not doing it now? So it can have a catastrophic effect on a company's balance sheet.
And can I just add in, Andy, I think because of this world situation, companies are a lot more open to maybe to paying up front. Like beforehand, companies would be a bit reluctant to ask people to be paid up front, but a lot have to do it at this stage. So I think there's a general world understanding that, because of the situation and the cash flow constraints, that it's not unusual for companies to be asking for payment up front.
I think it's a great reminder, Nadine, just to sometimes ask for what you need.
Yeah.
If they say no, they say no, but not asking, you don't get it. What I'm fascinated in here, just for a question for you, Chris, is the difference between country risk and company risk or product risk in here. Is this making, at the present moment, some countries actually almost impossible to trade with because the country risk is too high?
Yeah, I'll answer that. Can I just touch on the previous point though? So if you can get paid up front, that's great. An alternate, and we've seen the examples of some exporters coming to us and saying, my buyer wants me to double my credit term that I'm offering them. Right. And I really would like to do it because I want to maintain those sales. And yet we look at, well, what's the normal cash flow cycle of your buyer? So in other words, if your buyer normally is a supermarket and you would reasonably expect your goods to be sold, say, within 2 weeks, and they're suddenly now wanting 2 months to pay, you don't want to be helping fund their working capital, So that's just in this space, you got to be careful of that. And any insurer that you would go to, they would be very uncomfortable to provide, insurance in that type of scenario. Yeah. But coming back to your question, Andy, so yes, the commercial risk, the political risk, we're talking about their, potential import restrictions suddenly being put in place by a government, maybe a government that, or a country, say, that was heavily reliant on sales of oil, and with the price gone down, all of a sudden their foreign currency may suddenly depreciate, and they might start putting restrictions on payment in the US dollar. So it covers sort of that spread. Another one might be civil disobedience, and you've got stuff in a warehouse and that warehouse gets burnt down. Right. And so, yes, you're right. There are some markets where getting trade credit insurance is increasingly more difficult. That is a space where New Zealand Export Credit, we perhaps have a broader political risk appetite than the insurers. But equally, that's where we're seeing letters of credit being increasingly used. So in certain parts of Asia and the Middle East, often it's banks located there, they're often more creditworthy and have access to foreign currency than perhaps a small buyer.
Can I just jump in there too with, like Chris was saying, with those countries, using a letter of credit, we can actually add what we term as a confirmation to letters of credit. So the bank then takes on that risk, that country and bank risk and that sovereign risk. So sometimes we can look at those. Look at that when the letters of credit come in. We can't always add our confirmation or add that extra insurance to those LCs, and that's where we do look to the Export Credit Office to help us out there to add that extra risk for those particular countries and sovereign risk. But with the letters of credit, just wanted to check out there that we, there is a cost obviously, but for the expertise that we sort of give and share here, it's all free. So it's easy to come and have those conversations if you're wanting to look at any of the products that we've got there.
Okay, that's great. Thank you, Marie. On top of that, and it does feel this feels like an ecosystem rather than a single solution. So again, back to Nadine's point before about start with the person who knows your business and knows what that risk is first, and let them navigate you through between banks and Export Credit Office and Treasury and providers. Now it's like this is only part of the picture for exporters, because from what Hamish and I have learned over the last 10 weeks is that everybody is on a trajectory to at least understand and explore the prospect of taking part of their business online. And we know that getting paid through online channels is an entirely different kettle of fish. So just turning to you, Matt, over in Sydney, this is your world. It's like why is it difficult and needs a different approach to consider the way that you get paid and manage your cash flow when you're working off big direct-to-consumer platforms like Amazon, as opposed to what we've been talking about this morning about just general trading?
A fascinating discussion. There's a number of points that I could raise within this. I mean, the reason World First exists is just to help our customers, clients, if you like, make international payments at a local level. If you talk about the online world, it's a fascinating space to be involved in. We don't just do online, we also do importers, exporters, private individuals and so forth. But from an online platform, when you're talking around Amazon, it's understanding how that gateway platform works. The bank accounts that are required to give to Amazon is critical. And if people on this call understand Amazon, they will ask you, first thing they'll ask you is for your bank account. And they will want to know where that bank account is domiciled, and they'll pay back in the currency of that domiciled bank account. Where we come into the picture and where we help our clients across the globe is making sure that those bank accounts are domiciled locally in that region. So therefore it means the banking ecosystem reads those bank accounts as local bank accounts. So for argument's sake, if I'm in Australia and I'm selling on Amazon in the US, I would open through us a virtual USD bank account domiciled in the US. Amazon will read that as a local bank account. They will transfer the money immediately straight through. You can do one of two things then. You can either hold that money in account in the US and pay out to suppliers, be it in China or Europe. You can wait for a payment to come in and pay out in the same currency into the US. Or you can sit and hold that money on account for up to 90 days, like a natural hedge, if you like, and return the money when the exchange rate is at a better rate that you want.
So I've just got a silly question, Matt, on that. Is that why, if I'm going to start trading, I'm going to sell my pens, I'm going to sell them in Amazon in the US, why can't I just open a US bank account and trade from that as to be that locally domiciled account?
Great question, Andy. If anyone's tried, be it individual or business from Australia, New Zealand, tries to open a locally domiciled bank account in America, or in Europe or in Asia, it's an extremely difficult process to go through. In fact, in the US ecosystem, quite often they'll ask you to come into branch to open that bank account, and they want to see the system from there. You can open a NZD USD bank account, but it's not domiciled in America, so it has to run through the ecosystem, the international ecosystem of a banking network. I don't want to get too technical, but in essence,
I'll just jump in here to kind of give some other context to this as well. Like with Amazon, they're going to pay you, right? And they normally have a fortnightly payment cycle. They'll pay you the net balance, but they like to take nearly 3% on the foreign currency when they send it. It doesn't matter if you've got a USD account in New Zealand; they will still take their 2.9% forex, right? So you're actually losing quite a clip. Whereas a World First, for example, it's a lot lower. So you pretty much save 2% on that movement of funds. And even if you don't need to, if it goes into a different currency, then you got and you need to switch it back to pay someone in USD, then you lose twice. So that's part of the picture as well as a foreign currency piece here, as much as a getting paid.
That's it. Sorry, Andy, just on that, the critical part of that is Amazon will read that bank account as being a New Zealand-based bank account, and it'll convert it through its channel in foreign exchange, if you like, up to 3%, if you like, whereas ours will sit and be a local bank account, so it'll be a straight-through transfer in that banking ecosystem, so it's an immediate transfer. And then it's up to the individual as to where they want to move that money back, and I can guarantee that we would move it at a cheaper rate than can be done across the business.
Yeah.
So is this a common problem actually for you, Hamish, here, if I'm like not using Amazon but using another global platform anywhere else? Is this same complex setup required for locally domiciled accounts essential, say, if you're trading in China or trading in Europe on a different platform?
Matt might be better to answer that than I when it comes to other, like even if it's people just with their Shopify site and or with with Alibaba brands, etc. So Matt, probably better you to talk to that.
Yeah, thanks, Hamish. Yeah, each particular payment gateway, if you like, or marketplace has its own nuances in terms of its payment methods, and how you bolt on, if you like, to those particular gateways. Where we've tried, and we are making it more simple, if you like, for international clients to operate locally in market. What you want to be able to do is manage your funds into those particular gateways and ensure that you are getting the best possible price off the back of that, because there's a conversion rate at every stage when you are making foreign exchange conversions, even same currency conversions. So people need to understand what that means from be it a Shopify, be it Alibaba, Alipay, Lazada, 1688, all these marketplaces and gateways have their own little nuances. What we've been able to do is bolt onto those particular gateways, understand their onboarding processes, still put our virtual accounts linked to those, be it buyer and or seller, and allow customers to manage the flow of when they want to bring money either back into NZD, if they want to bring it back, or leave it locally for a period of time and pay out.
This is the two sides of the conversation are actually coming together here, I think, and the theme here is control, isn't it? It's actually making sure that you set up the structure deliberately and in advance. It doesn't matter whether you're just managing the risk of putting a container on the ship, or whether you're managing the risk of and the flow of cash from a foreign platform as well. It's about setting it up so that you're in control every step of the way.
Well, it's interesting, Andy. One of the key things we've found through the COVID process is, and where our business has, I guess, done well, is right now cash is king in terms of understanding and controlling your money. And our conversations with our clients, first and foremost, are you okay? Is everything all right? How can we help? And then it's about, okay, let's have a look at your exposure from a foreign exchange capacity right now, and what can we do to assist you in those areas. The virtual accounts are a critical way of doing that. It allows you to have full flexibility around your money. When you move that money, you determine when you want to move it. Yeah, if the rates work for you. So it lessens the impact from a foreign exchange, if you like, a transfer mechanism. You don't automatically have to bring it back and be swept on day, which could be a day rate, or you might have a specific rate with another broker or a bank as such, or you hold it and naturally hedge it and wait for a better exchange rate to come back, which makes it better for you. You can cash flow your business against that and use those funds the way you want to use the funds. Pay in, pay out.
Perfect. I think, Hamish, we might turn to some questions. I have an eye on the clock, and we're coming up to 9:45. It's like, well, I want to leave some time at the end of this just to be able to get everybody's advice on how to structure this and how to think about the different risk that's in front of them. But let's just take 5 minutes of questions, if we can, Hamish, before we come back to the topic. Who's been in touch?
It's good. So we've got a lot. We've got a lot of questions. So the after party could be quite fun as well.
After party.
Anyway, so we'll start off. I'll just start at the top, and then we'll work through, and then you chime in as required, people. So we've been considering offering. This is from Martin Carrington. We've been considering offering staggered payments for some of our more stable, larger customers in order to stimulate their ordering. Do you think it's feasible to try to build a little margin to cover that, or should we absorb it? So What do we think there? Maybe Chris.
Sorry, there we go. Look, yeah, absolutely. Because offering payment terms doesn't come without cost to you as a business, whether it's the trade credit insurance that you're having to pay for, and also the interest on any working capital facility that's going a bit longer. So yeah, that would be my feedback to that.
Yeah, and I'll just add, it's a matter of testing it, right? Like you'll soon find out if your customers will continue to order more because of it.
Yeah, it's an interesting kind of situation, isn't it? Where, like, you know, the sales people will be going, right, let's go sell some stuff, you know, and these internal tensions of the salespeople wanting to sell and kind of do deals, but then there is that risk to manage as well, and so that's the having to manage that often conflicting interests, I think is quite is going to be quite interesting. Okay, so and then Martin also had, what are your thoughts on offering a small percentage discount for pre-shipping payment? Any thoughts on that? This is really the upfront payment. Should you offer a 2.5-5% discount for paying up front? And are you seeing any success with that?
I'd say absolutely. Cash is king. So if you can get it in the door and still make a good margin on the product, great. I would.
Yeah, 100%. So, there's an interesting one here from Richard Altherington. Any ideas on how to deal with money trapped in sanctions? So I'm not 100% sure what that actually means, but if someone money trapped in sanctions, or is that a bit technical for what's going on here today?
Marie, have you got perspective on that?
Yeah, I'm just going to jump in there. So we've got so all the banks, they do have sanctions teams. So they've got to be looking at the flow of money in and out all the time to ensure that that it's all legit and that they're, you know, AML and everything there. So sometimes we do, with the flow of money, the sanctions will come back to us with questions, and we do have to go back to our customers just to clarify. It could be the goods that are going, could be the country that it's going in, or it could even just be something like the vessel having a sanctioned name or something. So sometimes it's just something very simple that can be remedied, but it's us going back to the customers to ensure that we understand exactly what the question is from the sanctions team, so we can free up that money to flow through as it needs to.
Yeah, if I can add to Marie's, it's exactly the same for us. You know, using our counterparty banks, our AML policy is the number one thing. So the due diligence or extra due diligence is done around our clients and where the money flow is going. As everyone can appreciate, the transfer of international currencies is a significant annual impost and money laundering and so forth. So we quite often will challenge our clients in terms of, we know we can see what their volume flow is. If that has a significant spike at any point in time, that will speak a sanction. We'll go back and seek further clarity and extra due diligence around our clients. And there's certain regions that either banks and ourselves just won't touch in terms of their jurisdictions. So it's understanding what the client's appetite is, what they're looking to do, understanding the underlying beneficiaries. And once you understand that, it should flow quite quickly.
Oh, perfect. Time for one more question, Hamish.
Okay. So, whoops, I just lost my, where to go? Here we go. So slightly, let me think here. He's trying to pick. So there's one here. I'll just go next. Ray here for Nadine. What is the mood for service exports? So we're not talking about physical products here. So like management consulting. So, and this is Profit Systems NZ. So consulting to the US or Canada. So
and this at the moment low, because consultancies is one of those discretionary spends. So a lot of companies have, parked getting consultancies, parked any sort of expenses that are not core to the business. I mean, it does depend a little bit on who your client base is and what you're actually offering, so there will be examples where that is still occurring, but in general, no, because people are just really focused on reducing down their cost base to the must-have expenses and the the discretionary expenses will come back as companies get more confident and sure of where they're going and what they need.
Okay, fantastic. Good answer. Excellent.
It's time. I just want to tease out a few little bits of advice about planning our approach to getting paid for the next 6 months, because we're still in uncertain times. And just a question that's kind of rumbling around my head from the conversation today is just about how to get your hands and to understand how your risk has changed. I mean, Mike, this is going to be a topic of intense conversation with anybody who's supporting your insurance. Have you got any advice or any tips about what information to get and how often to get that information, and how perhaps to work with your insurer differently in the next 6 months?
Thanks, Andy, and you're absolutely right. It's the ability for everybody to get information, and as I said before, information has changed. Financials are now no longer valid to a certain degree anyway, because they are indicators of past performance, not future performance, and the markets have changed. So as a specialist credit insurance broker, and all of the specialist brokers out there will be talking to their existing clients saying, we need to have early conversations with your existing insurer about the markets that you're selling into, the opportunities that are in front of you, and the products that you are selling. The insurers have been very, very open with information, and an absolute credit to them, because it's been a massive changing world for them as well. They're under pressure just like our clients are. They're under pressure from their insurance companies, from their reinsurers as well. And we have seen claims come through, and we will see more claims come through. So it's about an increased dialogue. Credit insurance, certainly in the last 5 to 6 years, has had a bit of a change in focus. Rather than it being an ambulance at the bottom of a cliff type of insurance product, it's being used as a sales tool. How to get into new markets, how to sell more to your existing customers, and using the information databases that the insurers hold to help work that. And Nadine touched on it before. You've got the sales guys wanting to sell crazily, and you've got your credit people, the anti-sales force, as everybody knows them as, saying, no, let's get paid before we sell more. And this is where credit insurance just works amazingly for exporters. And then you've got the export credit office that sits in the background, can come to the fore very quickly when you're looking at that country risk, political risk, and one-off deals that the main credit insurers just are not set up to do.
So it's a good reminder there, Mike, that the surety of payment is actually a part of our negotiation tactics when we're trying to secure deals as well. That should be top of mind. And Chris, just quickly.
Sorry, just jump in there. And is it if you're talking with your buyers and then talking with the insurance, like with Mike, and you can't get insurance on that buyer, are you really wanting to be selling to that buyer? So with the being able to talk to Mike and his team, and with all the main insurers, it's it gives you that little bit more extra comfort to be dealing with those buyers.
Thanks, Marie. Chris, it's like, as we're trying to track how things are getting better, or indeed getting worse, what's the best way to try to gauge on a month-to-month basis whether the country risk is a trajectory that's going to enable it to still be a viable market for you? And when is the point when you've got to go, actually, this risk is here for the long term, and perhaps try and find another market?
So on that, look, again, it's all around information. So the likes of Mike, brokers like that, they're close and they can provide that. MFAT at the moment and NZT, they both on their websites are utilising their ambassadors and trade commissioners, and they've got reports online where they're tracking both from a political risk perspective, but also sector specific in some countries around, where there might be history of downturn and non-payment. So, I suggest having a look online there as well.
Perfect. Again, is more sources of information at NZTE. Again, they've been fantastic all the way through this crisis. Just turning to you, Matt, please, just thinking about the need to be really organised and proactive when moving into a digital channel. It's not a magic bullet. It's a channel like everything else. What are the 3 or 4 key questions that we should be asking ourselves in order so that we can set up our payment structures correctly for digital platforms overseas?
First and foremost, you understand your own business and where and what you are trying to achieve out of that. Where are you selling into? Then the next question is understand the cost of foreign exchange. Do your due diligence in and around what it costs to move your money. There is a cost to it, regardless of whether people say there's no cost. There's only a daily fee, if you like, or a transfer fee. There's a margin fee on the foreign exchange. The best advice I can give to everybody, and when I talk to businesses on a daily basis, is foreign exchange is something they know they need to do, but they don't understand the complexity behind it. And it isn't a complex thing. It's actually quite simple. But you just need to understand what it costs you to buy the money to on-sell that. Once you know that, there are ways and means through us to understand how often you need to move that. And fundamentally, if you can limit the amount of foreign exchange transactions you can do, therefore you're keeping the cash in your own pocket, okay? And you're not going to be exposed to a foreign exchange. Do your research around the brokers and making sure you get the best rate. Make sure it's a transparent pricing model that you've provided, and make sure it dovetails in to all your other exposure, be it through credit, insurance, trade financing, and any other service that's provided within that. It needs to be a bolt-on when you're exporting and or importing, or even private high net wealth individuals. It needs to be a bolt-on to your overall strategy around how you are going to invest and or move money.
Perfect. The key thing there is that you have to have a strategy. So planning, as forever, is top of mind. Hamish, we're just about out of time. I'd love to see the results from another poll, if we can just launch one quickly in the last few minutes. Can we just launch the consumer sentiments one, please? We've been tracking our sentiments over the last 10 weeks, and it's just showing us a really good picture of how the country is feeling. Hamish.
Excellent. So it's rolling now. It's actually been interesting because it started a bit low, then it's improved, and then it had a little dip, and then we'll see how it looks today. Looking promising for those that are on here. And also, so by the way, folks, there's still like 11 questions here that we haven't managed to get to yet, and we understand some people will need to move on just with their days. But if you do want to hang around for another 15, 20 minutes or so, we'll get to these questions for you. Okay, so it's been like fascinating conversation, and there's been like lots of questions coming through, so that's encouraging. So all right,
bring us next.
I'm going to end the poll and share the poll. So we've got a statistically relevant.
You always say that.
I'll be a bad statistician or researcher, but here we go. So this is interesting here. So we've got 27% of people are more confident. That's actually a bigger number than it was last week, and the majority being in the same. So that is good to see. So I think it's been a bit of an uplift from last week. So
that is great news. And we know one thing about this podcast is that we love good news.
Yeah.
So just in the last 2 minutes before we go into the after party, I'm just going to look for some reasons to be cheerful from our sectors. Marie, to you first. Thank you for joining us. Thank you so much for bringing all the insights from the banking world. From your position at BNZ, give us a reason to be cheerful.
Well, we're just about done, hopefully in level 1 soon. So that's going to be a great way to start the economy, and everybody racing out there, spending lots of money. Hopefully all our exporters will start to be able to get a little bit busier in their world. So yeah, level 1, here we come.
Hey, perfect. Thank you, Marie. And Matt, thank you so much for getting up early and joining us this morning from Sydney. Give us a reason to be cheerful.
Oh, because I'm still breathing, and we're all still breathing at the end of the day. At the end of the day, this is the new normal. And what it does, there's opportunity that comes out of it. I fundamentally believe that. We're changing the way we do business. So I think if we continue to look forward and be positive around it, we'll be better for it in the end. It's just a change cycle we're going through.
That's wonderful. Thanks again for joining us, Matt. We'll see you hopefully in some future sessions. And Nadine, reason to be cheerful from NZTE?
Yeah, there's new pockets of demand coming out from around the world. There's new opportunities, and I know that's easy to say, but just evolving our business model as a country and as a business to position ourselves well in this new economy. New Zealand's got a really good opportunity to do this. You know, we've done really well at eliminating COVID-19, you know, and we've got some really, really strong aspects that we're in a really good position in this new environment.
That's awesome. And thank you so much again for joining us for your second time. It's been wonderful having you with us. Mike, from the insurance world, cheerful thoughts?
Listen, I'll tell you what I've really noticed of late is the collaboration between the private sector and government agencies. And I take a hat off to Chris Chapman and his team at NZEC. They have collaborated fantastically with the private credit insurer market. It hasn't been touched on today's or during today's discussion, but and maybe Chris, you might want to pick it up. There's a top-up facility available that the New Zealand government through NZEC is able to offer to exporters, and I've just been joyed and buoyed by the work that everybody, private and government has been putting into working with exporters. It's not about everybody clipping a ticket on the way through. We've seen collaborations such as this, Andy and Hamish, where we were able to reach out to exporters and to other people in the market. It's not about being able to send an invoice out for your time. It's about working for New Zealand Incorporated, as we've sort of heard in the past. So I've been encouraged by that, and I think, like a lot of other specialist credit insurance brokers, we are spending an awful lot of time talking to exporters, and quite often nothing will come of it. But we all work for large organisations, and we're all, we're all in this together. So I take my hat off to that collaboration approach that everybody's taking.
That is making me cheerful. Mike, thank you so much for joining us, mate. It's been great having you here. Mr. Chapman, you've got the last words.
Oh, well, Mike stole my thunder, so I've got to, on the spot, come up with something else now. Hey, look, I think it goes to new ways of working, and I think this form of webinar, isn't this great? I mean, why weren't we doing this more regularly before? You've got people from offshore and all around New Zealand linking in with a whole different variety of speakers. So I'd like to big shout out to you, Hamish and Andy, for arranging this. I think that's reason to be cheerful, and let's hope we can continue with that when we get to level 1.
Yeah, let's keep doing it. Let's keep going forward in a straight line. And we're out of time. For the formal bit of this, the after party is kicking off. I can hear the music in the background. The champagne bottles are being opened. It's on a BYO basis. From the formal bit, from Marie and Nadine, from Matt, Chris and Mike, that handsome devil Hamish Conway and myself, thank you so much for taking the time today to join us. Next week, Hamish, we're talking about wellness, about health and beauty, and going deep into the opportunities in that sector as well. So same time, same place. Hamish will be there. I'll be here, 10 o'clock on Friday. Until then, take good care of yourself. Have a lovely long weekend, and we'll see you next week. And feel free to join us for the after party. Thank you.
Thanks, everyone.
Thank you.
Right, so I'll hit the stop record. So everything's off record after this.